Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, Director of Investor Education here at PassiveInvesting.com. And today we are joined by Michael Schmidt. Michael, welcome to the podcast.
Thanks for having me.
Yeah, I'm so excited because we are going to dive into the details of the deal Cameron Run, which is 284 units in East Point, Georgia, which is a unique strategy. So I'm so excited to cover this. But before we dive into this particular deal, Michael, tell us a little bit about yourself, how you got into multifamily and where you're at today.
Sure. So my background, my undergrad was in finance and graduated during the Great Recession. Wanted to go into real estate, but there were no real estate jobs except for an appraisal because there was a lot of bank-owned assets that needed valuations. So I worked as a commercial real estate appraiser for 4 years. And while I was doing that, I went to school at night, got a master's in real estate. And then I switched to the acquisition side of the business, primarily looking for real estate on behalf of foreign investors, institutional capital. Did that for 6 years and then decided to go off on my own and start syndicating called True Workforce Housing. So it's like Class C, C+, B, B- assets. And so I've been doing that for about 3.5, 4 years.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy-day cash reserve with a high-yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
Awesome. Well, I'm super excited to get into the details of today's asset that we're going to talk about because, like you said, it is true workforce housing. All right. So we're going to talk about Cameron Run, 284 units in East Point, Georgia. And guys, that's right outside of Atlanta, right?
Yes.
Awesome. Okay. So let's start with, when did you close the deal?
We closed on December 30th, 2022. So the last day of the year.
Wow. Okay. So you guys just closed just a few months ago. Let's back up that timeline a little bit. When did you first hear about the deal and how did you find it?
This one we first heard about back in, I would say, April of 2022. It was brought to us by one of our broker contacts. We're based here in Atlanta, so pretty friendly with a lot of the local brokers. And this particular broker brought us our last deal that we bought. And so it was shopped to us sort of off market. Nobody knew about it. It was very important to keep it quiet for the seller. And so we found out about that, like I said, in about April. There was maybe 2 other groups that knew about it. And somebody put in an offer that was above where we were. And so we just said, well, it may come back around. And sure enough, a couple months later, that group was backing out. So we came in and put in an offer.
And when the deal came back around, were you guys the only group looking at it, or were you guys still in competition with other groups?
Yeah, it was just us. And the reason is because it's a low-income housing tax credit property, and these are a little bit more difficult to buy. And we had just bought one that was 294 units the year before. So we had familiarity with the process. And so it's not always about price and terms, and it's more about, in this case, surety of closing and understanding what you're getting into. And so we had the experience. So that set us apart.
So before we get into kind of the details of the contract, due diligence, and all that, take us through like just a 60-second kind of primer of what's attractive of this type of business plan. Why this type of strategy?
Yeah. So we've done this on one other property, and we were trying to find ways to find deals that made sense because the market was really frothy here the last couple of years. And so what the low-income housing tax credit property is, and sort of what our strategy with this one was, is there are restrictions on the property for 15 years. And then when those 15 years, when I say restrictions, they're income restrictions for the residents who live there. They can't make above a certain amount. And therefore, you can't charge more than a certain amount. And that amount is set by the county HUD. And so what's interesting, though, is when these properties, when they reach the end of their compliance period, you have the ability to submit them into what they call a qualified contract, which is the process of turning the property market rate over a period of time. So there's a lot of compliance issues that you have to deal with on the front end, but the goal is to gradually turn it to market. And a market rate property, there's a bigger buyer pool for that. So we do all the heavy lifting to get it through. There's some upside in it as well. And then the goal is to sell it when it's full market rate property or close to it.
So this isn't your typical like 3-5 year value add strategy, try to turn it really fast.
Yeah, because
this is a longer play, it sounds like.
It is, I'd say it's a 5-year.
Okay. So the deal came to you in April. You guys didn't win. You were beat out by another group. Comes back. That group couldn't perform. It comes back to you guys a couple months later. You get your offer accepted. So what did you guys purchase at? What was your offer on the property and what got accepted?
Yeah, we ended up, I can't remember what our first offer was, but we ended up at $35 million.
Okay. And what were your terms that locked up this deal for you?
The market is changing a little bit now, but even towards the end of, I would say, the second half of 2022, what we had been doing was and that's what we did for this one, which was a 2-week access agreement. And during that access agreement, we're negotiating the PSA, and we're also going in there and doing our physical due diligence and our financial due diligence. We have our own management company, so we have a physical guy who goes with us and walks all the units. And so we can do things very quickly. So we did that within that 2-week time frame. I think the negotiations went a little bit longer for the PSA. But then once we signed that PSA, it was a 60-day close, maybe a 30-day extension. So we had up to like 90 days.
Okay. And was there any earnest money down hard on this deal?
Yeah, there was $350,000.
Okay. And was that hard at signing or after due diligence?
Hard at signing, subject to title, environmental. So there were some hurdles, but.
Okay. So you had longer than 2 weeks to do your environmental and everything.
Yes.
Okay. So this 2-week kind of window that you were performing your due diligence before you actually signing the purchase sale agreement, walk us through like how you conducted due diligence and what did you find?
Yeah, I mean, for us, we're checking with these high-tech properties, a lot of compliance issues. So we're making sure that they have all their paperwork on the lease side. And with our management company, we have someone who specializes in that. So she's going in there and she's reporting back to us the things that are missing. And if it is missing, is it a deal breaker? Or can we get that document after closing? Those sorts of things. But for us, we're always a little bit more worried about the physical side of things. And I think one of the things that came up during that was the condition of the roofs. They looked like they needed to be replaced, but I mean, they were worse than we thought. And so that came up. Luckily, we had a little bit of room in our numbers for things that come up like that. And so it didn't kill the deal. But we had to budget more in there for roofs. But there wasn't anything else really that popped up that was problematic. A lot of times these LIHTC properties, they end up having a lot of money spent on them every 15 years. If you don't take them out of the compliance and you go back and get more tax credits, you invest more in it. So the infrastructure tends to be a little bit better. So this one was a 70s property, but if you drove in it, you would think it was an 80s property. So they tend to be pretty well maintained. There were some deferred maintenance issues, but that kind of thing we can handle. So there was no deal killers in it when we did our due diligence.
So, okay, if the roofs need to be repaired, did you guys just absorb that on your financial model, or did you go back and retrade with the seller? And how did this impact your ability to get insurance?
Yeah, no. So we did not retrade on it. We thought we would have to replace them, most of them, but I think it might have been an extra like 300,000 or something like that. So we were able to absorb it. I mean, we try to go into these things when there's a lot of unknowns. I try to pad it as much as I can so I don't have to go down that path. So we were able to absorb it. I mean, we still really liked the basis that we were getting the property at. So we just absorbed that.
Quick question, because I mean, this is something new to wrap my head around. Okay, if you picked up a LIHTC property at 35 million, let's pretend that that was already at full market value. What do you think that would trade at full market value?
Right. I mean, so that's the play here is that you have restrictions on these units. And if those units had no restrictions on it, how much more rent can you get, even without renovating? And so this kind of goes down a path here, which is another reason why we liked it. First, I'll answer your question is I would say there is an additional at least $300-ish per unit per month. If we had those units and there were no restrictions on them, probably more in their current state. But one of the things that happened, and we knew about this because we own another LIHTC property, is HUD did a big increase on their max allowable rents in 2022. It was like a 13% increase when they're historically 3 to 4%. So there's a lot of loss to lease to burn off in the meantime while we turn the property market rate. So that was very attractive. But yes, so then you can just do the math and say, okay, well, what if this is rents today are this much more? And even if they grow at 3% or whatever, some standard inflation number, the property is going to be worth a lot more. So the goal is to get it to that point, but it's not easy. There's a lot of compliance, a lot of paperwork, accounting involved, dealing with the Department of Community Affairs, physical inspections by the DCA. So there's a lot.
So it sounds like it's a strategy not for the weak of heart, but just quick math, $300 per unit, 284 units. That's like at least $2+ million. I was just throwing in a cap rate of 5%, but who knows? The cap rate could be lower on that particular property.
Yeah, absolutely. The upside is huge on these. And then if you renovate them, you can obviously do more. But for us, it's more about getting it through the process. And then somebody else can do heavier value add, like interior value add after. They're always developing more and more tax credit properties. So brand new ones are coming online. So sometimes people say, well, you're taking a property that's a low income tax credit property and you're turning it market rate and you're taking away some affordable units for folks. But first, they're building new ones. And number two, there's a lack of housing for people who make just a little bit more than the restricted amount. So if it's $40,000, the people who are making $50,000, there's a lack of housing for those folks. So it just depends how you look at it.
No, good point. Good point. All right. So we talked about the physical due diligence and a little bit about the strategy. Let's turn to the financial due diligence. You already alluded to that you had a team member have to go through all the paperwork and there were some things that might have been missing. Were there any surprises on your financial due diligence?
I mean, just a lot of missing documents and things like that. But our management team's really good and it's nothing that we couldn't fix after closing. So that's the biggest thing for us. Is it a deal killer or is it going to affect the price? And there was nothing like that.
And for this particular strategy, what would be a deal killer? What would have been something that you might have uncovered that would have possibly killed this deal?
I mean, just something that would be drastic in terms of the leases, where basically the income is much lower. But other than that, I think there's not a whole lot of deal killers. I mean, you just got to go through everything. But if there's some leases that are wrong, and that's okay, we'll get through it. What I say, it's not going to move the needle. especially on a bigger deal with a lot of units.
Okay. Well, let's transition to the actual lending on the property, because you're working through the loan on this property during a very interesting time in the market where interest rates are bouncing around. So talk to us, what kind of lending that you use? What was the rate? Were there any prepayment penalties, lockout periods? Who lends on a property like this?
It's an excellent question. So that's the challenge with buying right now. And when we did just several months ago, is that the debt side is changing by the week. And so what we were seeking was a deal that we could assume a loan. And this one had a very attractive loan assumption. So it had 10 years left. It was an agency loan at 2.99% with almost 4 years of interest only left. So very attractive, assumable loan. We're able to assume that, no problem. So we didn't have to deal with going and finding new debt, which was huge.
Anybody listening today would love to have those terms
Sure.
on a property. So let's talk about, if you were originating debt, who loans on these type of properties?
Your best bet is going to be probably Fannie Mae, Freddie Mac, one of the agencies. Now, what terms you may get today is leverage isn't going to be what it was a year ago. But if you got new debt on it from Fannie or Freddie, I think we were at a 50% leverage on the assumption, because we're paying a higher purchase price, obviously, than the last guy. But I doubt you could get more than 65% on that today anyway. So you're not getting that much more leverage on new debt, and your rates at that time is probably high fives. So the assumption is the way to go. Yeah. And with 4 years of interest only, that's very attractive. So in terms of exiting, it's a great thing to have. The next guy can assume they could get a supplemental. When rates come down, they might decide to get new debt. But at that point, the yield maintenance on it would probably just be very, very nominal, because they have this loan at 2.99. They would rather get a lot higher than that. So it made a lot of sense. And those are the kind of deals that have been working, is trying to get these assumptions, but they're not easy to find.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFIN Con happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers, and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event, as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFIN Podcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Well, let's talk about, you also raised capital on this deal. So let's talk about, what was your loan to cost? And then how much capital did you raise for this deal?
Yeah, it's been 3 months, but it feels like forever ago. The loan was $17.84 million. We raised, it was a combination of just private investor, LP equity, and we pref equity as well. And I think that was some sort of, I want to say around 20 million.
Okay, so you raised 20 million. It sounds like a couple tranches there, pref equity, and then also just kind of your Class B investor. How did you structure that with your investors? Like, did you offer a preferred return? What were your splits?
Yeah, so we've done a couple of different structures in the past, from European IRR waterfall to a straight a pref with split above that on cash flow. And then you had a capital event, 100% return of capital, and then a split. On this one, we just did a more simple structure like that. I think we did a 7% cumulative non-compounding pref. And if there's excess distributable cash flow from operations above that, then we did split. And then capital event, 100%, and then the split.
Okay. And on the general partner side, were there any other partners?
We've got a couple of, I would say, repeat partners that are in many of our deals. And so it was them.
Okay. And then one question that we get a lot is $350,000 hard at signing. How did you guys handle that? Was that something that the partners put up and take on that risk? Did you guys get an investor? How did you precede that capital?
Yeah, partners put it up. It's just the cost of doing business.
Awesome. All right. Let's talk about what fees did you charge on this deal?
Typical to what we normally do. We do an acquisition fee. I think it was 2% acquisition fee on this one. And we do an asset management fee, 1% of EGI or EGR is what we charge. And that's for obviously for finding the deal, putting the deal together. But ultimately, you don't really get paid unless you perform. So that's the ultimate goal, is to sell this property and execute the business plan so investors earn a strong return, and then the partners get to share in profits as well.
Awesome. So you have a heavy construction component to this property, it sounds like, or somewhat, some renovation. Are you guys charging a construction management fee?
I wouldn't say we have. It's not really a heavy lift construction. I mean, we would if it was, but it really, I mean, the business plan is to operate this efficiently. Like I said, replace roofs, and then all the other like capital items that we found during due diligence, replace those. So we wouldn't be charging a construction management fee, but for a heavy lift, we would.
Awesome. Okay. So I'm super interested to understand, when you take over a property like this, how does the first couple of weeks go, especially whenever you're trying to handle compliance and kind of fill in the holes of paperwork? And were there any surprises or any issues that crept up?
Well, yeah. So when we started out, we had third-party management and we weren't happy with the performance. And so what ended up happening, I think it was around 2017 or so, started our own management company. And that's headed up by somebody who has 35 years experience, and she oversees all the on-site staff, the hiring, you name it. So takeover, that's her domain. And so we have regular updates with her. We speak to her every other day. And so she can fill us in on all the mess that she's cleaning up. But yeah, I mean, there was trash issue at closing. There was all this trash that was left out. There was the compactor was broken. It was a 3-day going into a 3-day weekend. So that's how we started off. So we had to get all that cleaned up, going and finding all the missing files for compliance. So just a lot of that stuff, but we're lucky to have somebody on the management side who can take that on. And she's really great.
Here's a question that I probably should have asked at the beginning. I'm curious, what was the seller's motivation for selling this deal?
Yeah, I mean, we try to find out what the story is before we go into any one. And for this one, I think it was their first LIHTC deal. And as I mentioned earlier, they're not for the faint of heart. They're very management intensive. And I think they were out of state, and I think they were struggling finding the right management company to operate it. And I wanted to move on, and they bought it at a really good time. And I think there was a way for them to exit and focus on other things.
Okay. Step into their actual power there. Let this one go to somebody who knows how to operate it.
Sure.
All right. So a couple of questions for a wrap up. What did you find easy during this process that you actually thought was going to be a little bit more challenging? And then what ended up being challenging that you actually thought would be easier?
Raising money was easier than I thought it would be on this one. And what was more challenging was we were trying to get the property closed by the end of the year. I mean, primarily for tax reasons. But the challenge is getting approval for the transfer from the Department of Community Affairs during the holidays. They're like a quasi-governmental agency and very hard to get people on the phone and to respond to you. And the deal was just hanging out there. Like if we could close by the end of the year, if we could get approval, but it seemed like everybody was on vacation and gone for the holidays. So, I mean, I called every single person I could at the Department of Community Affairs trying to get a hold of somebody because the paperwork just needed to be signed off. We had already gotten verbal approval, but it was on somebody's desk. And we were just, how do we find this? I was prepared to drive down there and knock on doors. And somebody called me back and sent us the approval. So anytime you start dealing with governmental agencies, you're on their schedule. And so that was the biggest challenge. I thought we would get the approval sooner and it was coming down to the final hours and we got it, but that was tough.
Well, talk about getting an amazing deal closed in the 11th hour of 2022. Congratulations. Michael, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to find out more about you and connect with you, what's the best way they can do so?
They can go to our website. They can go to crownbaygroup.com. We've got a free ebook there they can download. You can see our track record. We're based here in Atlanta. We've owned close to 3,000 units, primarily in the true workforce housing space. So we're specialists here and we're really good, like I said, on the management side as well. So if anybody's interested, they can book a call with us, join our investor circle, but just go to crownbaygroup.com.
Awesome. Well, again, Michael, thank you for being with us here today. We look forward to hearing about your future deals.
Thank you for having me.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.